Steve Barsh from Dreamit, thanks for tuning in today on how to raise a round and how to cross the finish line. Recently, we gave a talk that was talking about how to put a pitch deck together and the elements of a pitch deck. And what we really talked about in there were 3 key things that go into a pitch deck. What's the story? What's the evidence? Why should anybody believe you? And what's your big, hairy, audacious goal? We talked about that as a completely separate webinar. What we're going to talk about today, though, is the process of raising and closing a round. Let me just tell you the origins of this information. So, Dreamit's been doing what we've been doing since 2008. So we've been doing this for about 8 years. And particularly a couple years ago, we just noticed this trend where companies would get a term sheet, but not actually close the round. They would fall short, they'd have a term sheet in hand, and things would fall apart. And what we started to realize was a lot of first-time entrepreneurs are kind of more inexperienced at raising rounds. What we realized is they really didn't understand the holistic process of what's it like to actually take in and close a round after term sheet. So that's what we're going to go over today. I'm going to focus more on the tricks and traps. There's some definitional information we're going to see in the deck. I'll go through that pretty quickly. I know a lot of Dreamit companies that are in the current cycle, for those that are watching that are current Dreamit companies, a lot of you have already raised rounds, so I'm not going to go over some of the most basic material, and I would just ask for anybody that is listening in to the live broadcast of this, if you have a question, bring it up in the Q&A here today, so just hit Q&A and I'll take the questions as they come in. Additionally, certainly ask your managing director during partner meetings or pull me aside or shoot me an email or catch me on Slack and ask me questions if there's stuff that we go over a little too quickly that you're not sure of. Most of the stuff is pretty straightforward. So let me start going through the material and make sure I'm on the right screen. Okay, so here's what we don't want you to be. Don't be this guy. This is a very famous scene from a track meet, somebody who thought just a moment before, who thought, there they are, like waving, hey, I just won, I'm about to win, I'm crossing the finish line. And the guy who's very determined to his right, your left on the screen with the W on his chest, passed him and he lost the race and celebrated a little too early. And I think what we've seen more than once at Dreamit is somebody gets a term sheet and they're like, yay, I've got a term sheet. And what we try to say is the deal's not done. You're not done until the money is in your bank account. So don't celebrate too early. It's great to have that enthusiasm, but we don't want you to fall short from actually closing around. So we're going to talk about the process today. So here's where we see where people fail to raise a round. Some of this we talked about recently last week in a different webinar. Most important thing is you have to have a believable story. What's your story and why should I believe you? We find a lot of times first-time entrepreneurs or early entrepreneurs that haven't done this a lot don't understand the overall process of closing a round. They don't own and drive the process forward. And let me hit this right here, right now. Something that's important for CEOs and founders of companies is when there's a round of funding, at the end of the day, you own that. I've seen a couple of times where rounds fall apart. And if you ask the entrepreneur, hey, what happened? What's going on? They'll say, I don't know. It was in my attorney's hands. They were driving the round. I was like, no. That's in the wrong hands. It shouldn't be in the attorney's hands. It should be in your hands. At the end of the day, meaning you own and drive the process. You can delegate certain responsibilities, but you can't abdicate the whole thing to your law firm. That's a very dangerous mistake that I've seen made more than once. So you're going to need to own and drive the process forward. Often we see that people don't understand the role and responsibilities of who should be doing what when closing a round and don't have the vocabulary down cold. There's a lot of words. If you don't have an MBA, a lot of these are very MBA and business terms that you may not be familiar with if you're more of an engineer. So we'll go over some of those today. But it's important to understand the vocabulary so you can talk the talk and walk the walk. So here's what we're going to talk about today. What does the process look like? Who should do what? What are the questions you should expect and when? What terms should you really know, kind of vocabulary terms almost? How do you drive it to close, and who should you reach out to for help? So I'm going to go along at a pretty quick pace here. I'm going to try to get this done in about an hour and 15 minutes because there's a lot of material to cover. I think the first thing that's important to realize, there's lots of players in this equation when trying to close a round. And I think the first thing that's important to realize is your round isn't a VC's top priority. It's your top priority. Oftentimes people are raising rounds, they really need the cash, they're up against tight deadlines so they can do things like make payroll. It's a huge priority for you. It's not as a big priority for a venture capitalist. If you can create urgency, and we'll talk about that, that's a great thing. But just realize it's not their top priority. So you need to stay on top of it and you need to drive the process. Okay, and by the way, all of you that are live at Dreamit right now should have gotten a copy of this deck in advance a couple of days ago, and you can certainly review it offline as well. It's easy to get through this material. It's pretty straightforward the way we put it together. And again, I'm going to highlight some of the things where we find people get really tangled up in fundraising. The other thing that's important to realize, not only is it not their top priority, but it's yours. It's not their first time at the rodeo, but it might be your first, second, or third time at the rodeo. Venture capitalists, this is what they do every single day. They're negotiating deals, the structuring deals, the refinement of deal points. They're driving this process. So just realize that it's your first time. You don't want to get thrown. You want to ask for advice. This is a classic situation where if you're not 100% sure, talk to your attorney, talk to us, talk to peers, and get their advice, because this is something often an entrepreneur does maybe once every 18 months, and maybe you've never done it before. Yet the VC that you're working with does this day in and day out, and they're very, very good at it, and they know the terms cold. So just realize to seek out advice and help if it's your first rodeo. Okay, so just some things on roles and responsibilities I wanted to go over. Who should be doing what when you're trying to get the term sheet, you've got a term sheet, and you're driving to close. Again, you need to own the process and drive it forward. It's important that you recognize that you don't know what you don't know. You're not going to know everything. Nobody does. And it's important to reach out for help. And it's also important that if you're negotiating or speaking with a VC and they're saying, here are the deal points, don't agree to things if you're not 100% sure. You can say, you know, that's interesting, I got it on what you wanted on liquidation preference or discount. Let me take a note of that. Let me check with my team and see if that makes sense. But don't commit to things and don't agree to things if you're not 100% sure. And often you're going to want to consult with your attorney. What's your attorney supposed to do during this whole process? They should be helping you understand the terms and term sheets. I've been through, I'm trying to think, maybe 10 times I've done fundraising rounds. And I would ask the attorneys I'm working with all the time. First, I'd read a lot and then ask them to educate me. They're very good at helping you understand the terms and the term sheets. They're usually going to help you understand the financial ramifications. If it's a 1x or 2x liquidation preference, participating or non-participating, it's important that you understand the implications of that. And your attorney generally can walk you through that if you're working with an early stage attorney that does a lot of venture capital work. They're going to protect you from potential legal issues and make sure to review all of the documents before you sign, not they sign. They're not signing anything except the bill. Anyway, so that's the role for you. You own it and drive it. At the end of the day, this is your process. You've got to hold on to control. Your attorney has a lot of roles. Dreamit, how we can help you. Our job is to guide you through this de-risking process, like when you'd be meeting with your managing directors every week, help you shape the story, educate you about the fundraising process, prepare you and take you on the investor roadshow, and then we're happy to serve as an advisor as well. If you're getting term sheets coming in and you want our advice, we're happy to give that advice. And as well, you can talk to attorneys and others. But these are kind of the main constituents that many of you will see. And of course, for some of you that are more advanced, you already have a board, you already have previous investors, they're going to be involved as well. So some other definitions and terms. You typically will have a lead investor. So again, some of you have already raised your seed. Some of you are almost at a Series A. So you might know these terms. What's a lead investor versus a regular investor? A lead investor is typically someone who leads the round. They're negotiating the price and the terms. They're usually taking a large part of the round. They are the ones that initiate kicking out a term sheet. They issue a term sheet. They'll start initiating due diligence, and they'll usually take a board seat, particularly when you're doing a Series A. So that's what a lead investor. Everyone else that invests is called a follow-on, and then the investor has their legal team that's going to work on the transaction as well. So those are some critical points. Okay, I'll get to something later. Just the terms are really important because I want to tell you some mistakes we've seen made over the last couple of years that we're trying to kill off all the mistakes. Dreamit companies are getting better and better at closing rounds, and that's why we keep giving this advice and just trying to make sure you understand the process. So at a high level, just remember there's two different classes of investors many of you are dealing with. There's angel investors, angel investors, all kinds of people that do angel investing. They're typically writing a check of $10,000 to $100,000. They're looking to contribute expertise. They're not typically taking a board seat. There's a lot of other aspects going on. A venture capitalist is a very different beast. It's an organized firm. It's an organized fund. They have limited partners, LPs. So realize a VC is also raising funds, in this case from somebody called an LP. And they're much more professional. They're much more buttoned up. They look at this as a serious business. An angel investor is a little less buttoned up and not as rigorous, but I'd say they're not trying to protect the investment, and doing things like board seats aren't as important, where a VC is going to say, I want a board seat, because the important thing to realize about a VC is a VC is investing other people's money. If I or somebody is doing, it's so many angels in the world, if you're working with an angel investor, they're investing their own money. If you're a venture capitalist, you're investing your LP's money. Now they have a fiduciary legal duty to those people to make sure they are protecting that investment, and they take that duty very seriously. So it's important to realize some of the differences and nuances between an angel investor and a VC. Okay, I want to just lay out the process here, generally what it looks like, and we're going to come back to this slide quite a bit. So first of all, when people say they're going to raise a round, I just want to set your expectations. Typically what we see, it varies company to company, but what we see typically happens when people say they're going to raise a round. And that is, for those of you going on an investor roadshow, for instance, coming up next month with Dreamit, when you do that bi-coastal roadshow, East Coast, West Coast, that's the start of the process, not the end. It's the beginning. We typically find that when an entrepreneur says, I want to raise a round, from the moment they go and start talking to investors, it's usually 3 to upwards of 6 months to close a round from dollars in the bank. Just to set your expectations, again, it's usually about a 3-month process. What does that overall process look like of raising a round? You start initiating investor relationships. You start reaching out, looking to pitch them. You go out and pitch investors. That's a lot of what's going to happen on the Investor Roadshow coming up next month for Dreamit companies. You wind up going to partner meetings if they like you and say, wow, that was really kind of interesting. Why don't you come back and pitch the partnership? That's a really good sign. If you get past that, it's when you get a term sheet. Then you're going to go through a due diligence process, a closing process with long-form documents, and receiving the wired funds. Those are generally the basic chunks of what you'll see is going through the raising around process. And we're going to take this as the organizing template for the rest of this discussion today and kind of walk you through some of the key points of what you need to do through this process. So the first thing is going out and pitching a meeting with investors. And I think you may have heard this from Dreamit before. A line we like to use quite a bit is, if you ask for advice, if you ask for money, you tend to get advice. And if you ask for advice, you tend to get money. So we always say ask for a lot of advice. One of the things that we find is really important when you're first meeting with investors, if you're going out on this roadshow coming up and you're pitching, one of the things that's important is to make sure you have a clear ask at the end of the presentation, and asking things at the end of that first meeting. What are the types of things that you would need to see to make an investment in us? I find, and we're going to talk about why that's important, I find that most early stage entrepreneurs don't ask questions like that. They don't ask closing questions. And it's really, really important that you do that. I mean, 9 out of 10 entrepreneurs I see will make a pitch and almost like close up their MacBook or their PC and kind of walk out the door and say, thanks for your time. But they don't actually kind of ask for the business. So it's important when you're first going in to ask for advice. And what does somebody want to see to actually invest in your company? What are they going to need to see? So what are they looking for in that first meeting with you? What are some of the key things when you walk in the door? If you're on that investor roadshow with Dreamit, you're in a 20 to 30 minute meeting. And what are they typically looking for? They're looking that the teams, and your whole team might not be there, so some of these things they might not see, but the team works well together, is passionate about the idea, right? They're looking for mission-driven entrepreneurs, not mercenary entrepreneurs. Just let me highlight what that is. They're going to say a lot of times, why did you even come up with this idea? Why are you doing this ed tech company? Why are you doing this health company? They want to understand, like, are you on a mission, or are you on a mercenary role where in 2 to 3 years you want to flip a company? Because venture capitalists and investors typically like to invest in mission-driven entrepreneurs, not mercenaries. And part of the reason is being an entrepreneur and building an early stage company is so difficult. It's important that you have that passion. They're looking that the team is qualified to work on the idea and is fun to work with. Right? They're going to spend a lot of time with you, so they want to find that you're fun to work with. They're going to look a lot at your customer acquisition strategy. If you look at the deck that we went through last week talking about what's in a good pitch deck, one of the things we talked about is what's your go-to-market strategy. Again, it's an area we see a lot of companies fall short. It's a little bit like, and then a miracle occurs and customers come in. You're going to have a great go-to-market strategy, really understand your competition cold and really well. They're looking for that. They're looking that from the business model aspects, that there's a very clear value proposition, who the target customer is and that value prop, and we talked about that, and the importance of your positioning statement, that your solution addresses a problem that's actually worth solving. Is this a big and urgent need, and that there's a large total addressable market. over time. And then there's just a general je ne sais quoi that it seems investors are looking for. They're looking for some secret sauce that you have an unfair advantage, you've got great momentum or predictability. These are or statements between these. It's something that's kind of hard to put your finger on, but what you want is you walk out of that room and the investor just turns to another investor and goes, wow, I want to invest in that team, that company, and that idea. And there's a whole bunch of reasons there, but it might be this just je ne sais quoi. They can't put their finger on it exactly why. It's a great team, great idea, lots of great traction, and just something about those entrepreneurs, they have it. And it's hard to put your finger on it, but that type of thing that you're looking for, or they're looking for. When you're looking to talk to investors, and when we're looking at investors for the roadshow, also looking at the probability the investor can actually close the deal. Are you meeting with a senior partner or junior partner when you're doing follow-up meetings? Also, how much dry powder? Where are they? If they raised a $100 million fund, are they a year into the $100 million fund? Are they 4 years into the $100 million fund? Please note that when a VC raises a fund and starts investing from it, they'll usually put 50% reserves on the fund. So if they have a $100 million fund and they've already invested $60 million of it, they're probably not making new investments out of that fund anymore. It's kind of important to know where that VC is in the fund. You want to understand their knowledge and network within the world that you're in. So if you're making some specialized K-12 software, you're making some type of diagnostic test for healthcare, how much do they know in that space? It can be helpful that you want to assess and understand their level of knowledge. What's their reputation within the startup community? We'll talk about a lot, and a lot of Dreamit companies did a very nice job on this when coming into Dreamit, where people called previous Dreamit companies and said, what was the program like? What were the managing directors like? What was Steve like? That's great. So you want to find out about the reputation of the people that you're doing business with, because when you get in bed with a VC, it's usually a very long-term relationship. You want to make sure their reputation is good. Also, for angels that you're dealing with, what's their level of commitment to investing? Are they just doing it as a hobby? They're going to write you a check for $5,000 or $10,000 and then never be there for you? Or are they a little bit more professional? That they're there, they'll take your call at 10 o'clock at night. Or if you want to talk strategy, are they going to be there for you to help you at some of the trickier times? Okay, when in this early stage when looking for investors and first going out and pitching investors, just make sure it's important that they can find you. We've hammered this home in managing director meetings and on Slack channel recently at Dreamit. Just make sure all your profiles are really rich. You guys have been doing a great job updating your Gus profiles and Angel List, startups.co. Just keep them all, your LinkedIn profile, make sure they're rich. Make sure that they look really as great, have as much information as your pitch deck, because people are going to be Googling you all the time. That your story is consistent across all these platforms. If you're changing your go-to-market strategy, if you're tuning your positioning, make sure you tune it across all of those channels. Include numbers to demonstrate your traction of where you are if those numbers aren't confidential. And you can ask backers to endorse you to their followers. I have people that reach out to me, and I'm sure the other Dreamit people do as well. When you're on Gust or Angel List, can you verify that Dreamit's made an investment, or can you write me an endorsement? That social capital is helpful. Again, this is just finding investors before you've gotten a term sheet. Some profile tips. I'm not going to go through every piece here because you can read this so easily in the deck. You want to have that social proof. Make your profile very visual. You can put in screenshots and videos if you'd like. Distill your company into tight sound bites. Can you get it down to an X for Y? It's like, it's pet coaching. It's Uber for pet coaching. It's an extreme example, but can you make it really, really succinct as to what you're doing and update that status section regularly in these different profiles that you're using? Okay, and again, I want to go kind of quickly because there's some areas I really want to hammer down on that are where we find people make mistakes. So one of the important things is you need to be ready to raise. You're ready to raise, you're ready to close a round. So being ready to raise means you have a solid marketing plan, you have a solid go-to-market strategy. When people say to you, how are you going to find customers? How are customers going to find you? You have to have a very solid answer around that. You need to understand your competitive analysis, and you need to have good, solid plans to validate your untested assumptions. Because when you meet with an early stage investor, they're going to challenge you and say, here's certain things, here's 2 or 3 things that we still think are assumptions. You need to have a plan for those key things. I think a lot of those will come out when we start meeting with the teams and the companies over the next couple of weeks. We're going to do kind of mock VC meetings with you and pound on really hard questions about your business, and to make sure that those plans are in place so that you have an answer for a lot of assumptions that may still be in your model or risks that can be in your model. As you get ready to raise, also think about this. What momentum can you create around your story, around your company? It's a great time when you're getting ready to fundraise. If you can sign on customers, if you can close those last couple partnership deals, it's great when you're meeting with a VC to say, look, in the last 4 weeks, we've signed on 3 new customers. We've started 2 new trials. We've gotten 4 new partnerships in place. It just shows momentum, and investors typically like to see momentum to make an investment. If you can, with PR techniques that we've talked about somewhat during this program, can you raise your media presence 4 to 6 weeks prior to raising? You know, what blog posts, articles, if you have the bandwidth to do that, it's great, because people start searching on a company they've never heard of before, and if a couple of news stories pop up, again, it starts to build momentum and makes the story more interesting. And it could even be you writing your own blog post on Medium. Better is if you can get PR coverage, but terrific to start thinking about, you know, an investor meetings and a set of investor roadshow or going out and pitching is not just a one-off event. There's a lot around it, and think about how you could build momentum from a few different angles. Wanted to make a special note for those companies that are kind of post-seed pre-Series A. Here's the type of things that we see when you're starting to take off, or some of the more important things to hit upon. So first of all, think about what are the metrics that are most relevant for your business that are going to help show traction, growth, and potential. So every business, it varies what it is, but what are your metrics? What's going to show traction? Is it users or customers? That's if you're B2C or B2B. What's going to show that growth? Is it your revenue, how that revenue is growing? Is it how your pipeline is growing? Are you sitting there and having a discussion saying, we have 24 companies, 24 enterprises in the beginning of the pipeline, we have 10 companies on trial, we have 7 customers that are already closed. You're just trying to show tremendous metrics that show that growth and potential. Now, there's a lot of VCs that we meet with. I met with one last week in the Philadelphia area. They don't write a check until they see a company hit $5 million in recurring run rate revenue, right? That's just where they are. Now, he's a little bit later stage investor, but a lot of times for a Series A investor, particularly in healthcare, they're going to want to see, I've heard, as little as $1 million and as much as $3 million in annual recurring revenue, ARR. So a lot of times the VC has a very hard limit. So you have to think about, if you say you're going out to raise a Series A, just make sure in this climate, there's a certain level of revenue expectation if you're going to be doing that and making that statement. And I'm going to come back to that in a minute. Sometimes it's not just a hard revenue number. This is, I think, an important thing to think about. If you have, you know, it's the change in rate over time, right? This is about velocity. So if 3 months ago you had no sales, 2 months ago you had $10,000 a month of sale, a month ago, you were at $40,000 a month, and this month you're trending towards $60,000 a month, so the rate of the curve is going up very, very quickly. A lot of VCs will say, well, you're not at a $1 million run rate revenue, but oh my gosh, that's incredible growth in the last 3 months. They're just looking for that velocity. They're looking for that vector. So really, to get from your seed to your Series A, if you've closed a seed and going to a Series A, you really are starting to focus on sales, marketing, growth hacking techniques to really start hitting your metrics really hard. Now, one thing I want to bring up here is just around the optics of a letter. So when I say raising your Series A, just make sure, I learned this from a good friend of mine years ago who taught me the trick. Don't burn a letter if you don't have to. So a lot of times I'll hear people saying, well, I'm raising a Series A. That's terrific. Did you raise a seed round? Well, nah, it was more of a friends and family round, but now I'm raising my A. Don't do that. Don't burn a letter unless you absolutely have to, because the optics around that letter, when you say Series A, there's all kinds of expectations when you say you're raising a Series A. It's why you see a number of companies will say, well, I raised my friends and family round, then I raised a seed round, then I raised a seed 1, then I raised a seed extension. They'll keep using the term seed. So just be careful if you're trying to raise a Series A. There's going to be a huge expectation these days in today's climate as to what your revenue looks like. So if you haven't raised a seed, go raise a seed or call it a seed. Again, I've seen this mistake made many times, even when they're talking to an investor, well, I'm raising my Series A. Again, just be careful on expectations. So I'll keep going. I just want a couple points on that we see people making a mistake. So we talked about pitching investors, building momentum, building the story, getting PR, some of the metrics of what needs to go into that. Let's talk next about the next section. We're out there pitching and getting in front of investors. So one of the common questions that we see that people get confused about is when you're out pitching, exactly how much should you be asking for? It's a very, very common question. People say, how much should I be asking for? And I think the most important thing to think about is you need to be asking for the amount of money that gets you to your next demonstrable milestone, your next inflection point in your business where it's going to like pivot and start to take off again. Typically, people will often see that takes about 18 months. It's just the nature of the beast. But what's important is to realize that time is not a fundable milestone. This is a David Bookspan from Dreamit quote. He uses it a lot, and it's a very, very important point. So what we mean by this is if you're going out and you're raising for your early stage company, they say, well, how much are you raising? Well, I'm raising enough for 18 months. I don't know anybody who wants to write a check to a company for a certain amount of time. They want to write a check so you can get to that next milestone. So think about what's it going to take you to get to that next milestone. Remember, things always seem to take longer and cost more money. You don't always hit your goals, and you want to leave yourself with enough room just to think about that it's still going to take you 3 months to raise the next round. So again, typically it's 18 to 20, 24 months of cash that people are raising, but you need to think of it from a milestone point of view. That's how much you should be raising. How big do you have to grow to your product team, your sales team? How long is it going to take to get market adoption? So you back into that number based on where your inflection point is going to be or how long it's going to take you. Now, the next thing is just make sure, I'm going to go kind of quickly through this section because quite a few have already raised, but to make sure you understand the terminology really, really well here. When you say you're raising $1 million at a 4 million pre, you've got to know, a number of you that are watching this already know this type of material, but it's important that you understand the terminology before you pitch, okay? So let's hit some of them in a moment. Thing I want to talk about before that, in pitching, one thing I like to communicate to other entrepreneurs, and I've done this a lot myself over the years, is realize that when you're raising capital, it's a sales process. So I just want you to think for a minute. When you're going out and meeting all the companies listening in today at Dreamit are ed tech companies and health companies, right? When you're out there meeting with a K through 12 school district, when you're out there meeting with a university, a hospital system, and an insurer, you treat it like a sales meeting, right? You talk about your product. When you're meeting with a VC or an investor, I want you to think of it just like sales. It's the same thing. It's no different. Instead of selling your product, this time you're selling your equity, but you're selling something. And I want you to think of it that way because I always find it helps me to focus, right? So you're selling equity in your company. You can ask closing questions just like you would at a university or a hospital. You'd say, well, what's it going to take? What are you going to need to see to use a product like ours? You can ask those types of questions, closing type questions or trialing questions when you're raising money as well. So you can ask about the time frame and the decision-making process when you meet with a VC. You can say, what do you think next steps are? What would the time frame look like if you were making an investment like in something like this? You can ask those qualifying questions. I would say less than 25% of entrepreneurs I see pitch do anything like this, and I think it's a big mistake. And I find generally VCs want to see entrepreneurs that think in a they're like a sales-driven CEO, and they take that process seriously. And it's important for you to know when you're going to do what we call a trial close. Is this something you would invest in? And then be quiet. They can answer that question. Well, I'm not sure. And then you can come back, well, what aren't you sure about? I'm still not sure that the total addressable market is really that big. Great. If I showed you additional information about the total addressable market, would that satisfy it? Is that your only concern, or do you have other concerns? And you can ask those questions and flesh out what the issues are, right? And it comes down to the final big question there at the bottom. What would you need to see to make an investment like this? I think I talked about it on an earlier seminar. You can do the same type of thing if you want to be a little more abstract. If you don't want to ask the investor directly, if you just say, look, I know you're a great Series A investor. What are the types of things that you think most Series A investors would want to see from a company like us before they'd be willing to make an investment? So that way you're not asking them directly, you're asking them a little bit more obtusely. Generally, what do you think people would need to see? Okay, so think of raising capital as a sales process. When you've done that first pitch meeting, what are the things you should be doing after the meeting? It's good, normal follow-up etiquette. Right? Send the question materials. If you had open issues and they say, could you get me such and such, make sure to get that to them right away. Proactively answer potential questions. In the first week or so, find a reason to re-engage. Can you show additional momentum? Put them on an email list that as you do updates about momentum, keep them warm and updated. See if you can do a favor for the investor. Always kind of nice to get on their good side. And also try to build a sense of urgency. If you're trying to put together a round and saying, look, I'm going to the West Coast, I'm going to the East Coast, even now, if you have investors and you're getting ready to do an investor roadshow, and you have somebody who's thinking about putting a term sheet on the table, what a great way to build a sense of urgency. Look, at the end of June, I'm going on an investor roadshow to Boston, New York, Philly, San Francisco, and Silicon Valley. If you want to issue a term sheet, I'd be really interested in seeing what you're thinking before we're even on that investor roadshow. So think about where you can create a sense of urgency and have a little bit more control over the fundraising process. Okay. Again, we talked about the importance of demonstrating momentum and in your metrics. And that momentum could be user numbers, revenue, channel partners, whatever metric that we talked about is most relevant to your business. Think about that. How can you start tracking those metrics and showing them to investors? Okay. When you've gone in and pitched, try to see if you can build a rapport to a certain person. Who's your inside person going to be? Usually you need a champion. It's just like sales. You're at dealing with a school district, you're dealing with a healthcare insurer. Usually you wind up with someone who's going to be your internal champion and guide you through the process. You're looking for the same thing in the fundraising process if you can build an internal champion. Okay, so let's say somebody starts showing interest in you. What do you do? How do you go from there? So investors are going to move forward. How are they going to move forward? They're going to start to get to know you by looking at your connections on LinkedIn. Again, make sure your LinkedIn profile is very rich and very up to date, and you should be linking into people like mad. They're going to be talking about your company with other experts. They're going to be asking you possibly for a valuation. What valuation are you looking for? Please note that when you're a seed level investment, equity investment, or if you're a Series A, typically your valuation is kind of mathematical. I think we talked about this earlier, but just to point out again, if you say to somebody that you're thinking about a $4 to $5 million valuation, typically a company is going to be selling about 20% of their equity. So if it's a $5 million valuation, pre-money valuation, you're really going to be raising around $1 million, so you could back into it. So they might be asking you for valuation guidance. How else do they move forward? They'll invite you to a partners meeting, they'll issue a term sheet if they're planning to lead, and help you start finding other investors. And we're going to talk about some of the intricacies of finding other investors and things you want to watch out for about what you disclose between investors. So if you're meeting with an investor, you can soft circle them and say, look, are you in? And they'll start to give you signaling. Will they let you use their names with other potential lead investors, actively engage in networking? So if you have one investor, you could ask them, are there 2 or 3 other investors you typically invest with that you think we should be reaching out to? You can absolutely ask that. You can soft circle them if they name a specific amount. If they say, well, I'd put in $500,000, I'd put in $1 million. Soft circle them and start building that round. If you're trying to raise a $2 million, $5 million, $10 million round, start adding them all up and soft circling them. And if they'll set a specific criteria to meet it. Sometimes they'll say, well, if you find a lead investor, I'm in for $250,000. And a lot of times it'll be for a certain dollar amount. So you can start soft circling and building the round and building momentum. The key, though, is finding that lead investor. And we'll talk about that. One thing I want you to be careful about that we advise is be careful about name dropping if you don't have a lead investor or if you don't have a term sheet signed yet. So one of the things that we see that's a mistake that entrepreneurs will sometimes make is they'll start disclosing to prospective investors who they're speaking to. So it just says here, don't disclose prospective investors until the term sheet's signed. Okay, so one of the reasons why is, let's say you're talking to a really interesting firm, and that's firm A. And now you're talking to firm B and saying, well, I'm also talking to firm A, and it looks like they may issue a term sheet. Firm B might talk to firm A and say, look, let's both go in, but let's go in with these terms, not those terms. So it can actually work against you. So you have to be kind of careful when you're disclosing terms, or when you're disclosing venture firm names. So not disclosing the terms, investor terms increases the likelihood that you'll get multiple term sheets, right? So if you're meeting with investor A and investor B, and investor B says, who else are you meeting with? Well, we were in Boston earlier this week. We met with some Boston investors. That's fine. Just leave it at that. Well, we're not sure if we're going to issue. Well, there's a few other investors. We're expecting a term sheet over the next week or 2. If you're interested, we'd love to see the terms that you want to give, because you want the ability to pick and choose from different term sheets, right? Which term sheet provides the best deal terms to you versus investors going around you and kind of coming up with their own synthesized term sheet. Certainly do share the committed lead investors to other prospective investors once the term sheet's signed. Then you can, because the term sheet's signed, because it adds credibility. But just be careful about disclosing investors before you have a signed term sheet. Okay, so let's keep going and getting towards that term sheet and moving forward for raising around. Okay, so I'm not going to go through every detail because I don't want to bore you to death. I'm going to go through some of the things where we see the most common mistakes. Please read the material. If you have questions, ask us, ask your attorney, ask in your managing director's meeting, give me a note on Slack or email. Happy to answer these questions. So some of the economic things that you need to understand are going to be about price, liquidation preference, and founder vesting, and we're going to get into some of the control issues that you need to watch out for when you're going through a fundraising process. So again, it's important. We talked about you want to know the lingo, and I'm going to give you an example. I'll give you some live, real-life examples from last year or two where I see people make mistakes with the lingo. So things like preferred stock, pre-money valuation, option pool, and fully diluted valuation. Let me just talk about this for a minute. You know, when it's a preferred stock, I've learned, like when I did my computer science degree, I would just take words and read them backwards. Well, it's a stock with a preference, right? So what's preferred stock? It's a stock that has some particular preference. So it might be a liquidation preference, but typically when you're selling an equity round or like a seed or even a series seed, it's going to be a preferred stock versus the employees who have common stock options. So the investors have this special preference. There's the pre-money valuation, that's pretty obvious. What's the amount, what's the value before the money comes in? An option pool, it's going to be important for all of you to have an option pool for future employees. Here it says about 15 to 20% unallocated option pool when you're a very early stage company. Sometimes it's as low as 10 to 15%. So that's for employee stock options that you're going to have that pool there. And we're going to get into some of the important aspects of that in a minute or two. And then the fully diluted valuation, when it happens after full dilution, when everything is exercised. And you can read that, it's pretty straightforward. Some pricing terms, this just talks about the investor is going to put in $1 million, and what is that $1 million going to get them? If you were at a $4 million pre-money valuation plus $1 million comes in, it means it's a $5 million post-money valuation. They put in $1 million, they own 20% of the company. Here's points about what happens in an option pool. If they say, we want you to have a 20% option pool set aside, if you look at the net of it, if the investor is owning 20% and you're putting 20% in the option pool, it means you're going to have 60% left over. So these are just some examples. They're pretty straightforward if you just read on the left and read on the right to make sure you're comfortable with the terms and how it's working. Because again, I want to hit on some of the places we get people, we see people really getting caught up. Liquidation preference, really important. So preference we talked about, remember there's some type of preference on that stock for the investor. So here we talk about the preference in a liquidation preference, a multiple of the original investment is returned preferred stockholders. The net, I'm just going to jump to the bottom here and I'll go backwards. Right? The most ideal type of term when you're doing an investing round or like a Series A is you want non-participating shares with a 1x liquidation preference. If they put $1 million in, basically they're going to get $1 million out if it was a 1x liquidation preference on liquidation. You could have a 2x liquidation preference where they're going to get 2 times their money out. $2 million before other people get paid. So you're looking for typically a 1x liquidation preference. Most great VC firms will have that kind of 1x. Depending on who you're dealing with, you might see that liquidation preference drift higher. The whole aspect of it is around participating or non-participating. That just means if it's non-participating after that preference, let's say there's a 1x liquidation preference is paid out, will they get anything else or nothing more? So non-participating means they get a choice. Participating basically means they get 2 bites of the apple. They participate in the liquidation preference and then the shares that are going to come back out on a change of control or an acquisition. And you can have caps on it. But liquidation preference will be an important term. Again, we can go over it in managing directors meetings. We can go over it. You can reach out to me and can explain it. Stuff is pretty straightforward. You just need to slow down, read it, and say, got it. And all of your attorneys can help you with these types of terms. And if you're getting a live term sheet, you're going to want them to walk through it carefully anyway, because they deal with it all the time. Here's just an example of a non-participating, it's just a clause of a non-participating term sheet as we go through the process. This is getting the term sheet and understanding some of the lingo. Here's a non-participating investor. They can receive, this has a 1x liquidation preference. They can receive one-time initial investment back or convert. So it's non-participating. They don't participate in both. It's non-participating. Again, this is what you really want to see. It's a non-participating. There's another example where it's fully participating. So imagine you're getting acquired and it's a fully participating. So now the investor gets first their original money back that they invest in you. Let's say it's $500,000. They get their $500,000 back, and they get their share in proceeds according to the equity, along with the common stock. So they almost get like 2 bites at the apple. They get their money back, and then they get their other portion. And typically you want to see if you can get non-participating. It's more favorable to you, the entrepreneur. Founder vesting, again, I'm going to pound through lots of lingo really quickly here. Founder vesting, it's important to realize if you're not vesting into your current company, most of the time, I'd say 90% of the time, when you get VC investing, they're going to have you vest into your own company. And let me tell you why. It's very, very common. What an investor, let's say you own 25% of your company, and an investor says, cool, I'm going to write $1 million into your preferred series seed. I'm going to write $1 million check, and you own 25% of the company. And you say, you know what, thanks for writing the $1 million check. I'm going to leave now. I'm going to let the rest of the team work on it. I own 25% of $1 million company that's worth $1 million. I'm sorry, maybe it's probably worth more like $5 million post-money valuation. Cool, I own 25% of that company. I own around $1 million. Let me know how that all works out. I'm out of here. I hope it all works out well for you because I own it. They're not going to let you do that. What they're going to force you to do, even though you founded the company, is they're going to force you to vest into your own company, believe it or not. So founder vesting, it's very, very common. Often you're going to vest over 4 years. A lot of times you'll get credit for like a year. So you'll vest over a 4-year period, and you'll get 25% accelerated vesting when they put their money in. So you already have a quarter of it, but you're going to vest over time because they want to make sure you want to stay with the company. Okay, so it's very common. There's also this idea of a cliff. So time, often a year until vesting begins. So this, a lot of times it'll say the first 25% of your X% doesn't vest until after 1 year. So they might put a cliff, and then it'll go month by month, and there's an initial cliff you have to get to. Again, it's just terms that are important to know, that you want to kind of have a general feeling for what these are. Your attorneys can help you. We can help you with them. Okay, here's just an example of some language with a cliff. Okay, so there can be reverse vesting, single and double trigger vesting. Single and double trigger gets into if you're going to be acquired or not. These are very detailed. Again, we can catch up on these. If you just read them, they're pretty straightforward in what they mean. 2 triggers, 1 trigger, particularly important for when you're getting acquired. Okay, just the example of it. Again, there's some areas I really want to hit on. So here's those terms we talked about. Basically, things you're going to want to know. We'll wrap a lot of this in as we continue the discussion here, but just some terms that you want to know, and I'm going to give you some examples. Some protective provisions that'll be important. So these allow the investor to veto actions of the company which may impact the dilution. So these are protective provisions that you want to be careful of, that they're going to bake in there. Again, you're going to want to work with your attorney on all of these types of things. If the investor is going to want protections inside the documents, particularly when you get the long form documents of what you're allowed to do and what you're not allowed to do without board control. It's interesting because a lot of times I'll see an early stage entrepreneur say, I've got complete control of my company. It's great. I still own greater than 50%, but they don't realize the investor has certain protective provisions. Like if you want to write a check for greater than $25,000, you're going to need board approval to do that, even though you own the majority of it. So there's a lot of things that are important about protective provisions that you realize what they are and what you as the CEO or founders are allowed to do and not allowed to do without investor permission. Okay. Factors. Again, I just want to hit some of the high points as you go through and closing around. I was just talking to a team about this the other day. Your preferred arrangement early on is that 2 people are elected by the common stock and 1 is preferred by the investor. But investors will often negotiate and say, well, you know what? Now that I'm coming in and I'm going to be a VC, we can have 1 founder, me as the investor is going to take a board seat, and then let's have 1 independent board member we agree to. David Bookspan hits on, just credit where credit's due. David hits this on a lot. If you can, don't allow that to happen, because now you've basically lost control of the board, right? Because the investor can pretty heavily try to influence that independent investor, and now it's could be 2 against 1. So if you can avoid having that independent, it's great. So it's more even-footed. For the seed investor's board seat, just think about if you're doing a seed investor, that should convert to an observer seat at the next round. You don't want your board getting too big, and certain people are going to come on and off the boards. And a lot of times, early stage investors will do this because they can't stay with a company for too long because they only have so much bandwidth. And just to realize, and I've had boards, I've had board observers, just realize that a vocal observer, somebody who doesn't actually have the right to vote at a board meeting, they're just a board observer, they're able to sit in. A vocal observer can actually heavily influence a vote as decisions are made. Now, generally when I have board observers, I have them fully participating in my board meetings. They're usually smart people, I like to hear what they have to say. But just to be careful, if you just give away, sure, you can have a board observer seat. Be careful because they can pretty heavily influence the discussions at board meetings. Okay, a couple more things. There's a lot of lingo around control. What's the participation right, drag along rights, conversion, and exclusivity? Again, I'm not going to go through every individual definition here. They're pretty straightforward. Just understand, for instance, it's called a drag along right. What does that mean? It means they could be drug along. It means all other shareholders must sell their shares once a majority of investors and common stockholders agree to the sale of a business. So a VC could say, we're going to have drag along rights that if, as the majority says, this is what we're going to do, we are going to sell the company and drag it along. You don't have to memorize all this. You just want to be somewhat familiar early on. Because again, if you're into this level of detail, you should be working very carefully with your attorney so they can review everything that's getting baked in. Okay, I want to talk a little bit about when people are saying, well, am I raising a convertible round or am I raising equity? So when people talk about, well, I'm going to raise a convertible round, why would you do a convertible note early on? So just want to hit upon that lightly for those of you that haven't dealt with this before. When you're doing a convertible note, there usually, and usually is the key word, right? There usually is an evaluation issue. Somebody's not saying, well, I'm raising a 1 million at a 4 million pre or 2 million at an 8 million pre, right? It delays the valuation because I'm raising debt. I'm not raising equity. Doing convertible note is usually faster. It's less legal cost. It's a faster negotiation, and you're returning the majority of the voting stock because you're not selling stock. It's just debt. So a lot of times early on where you can't even settle on what the value of the company really should be, people will raise convertible notes. It's a little easier to deal with. And then they take convertible note and buy something like this. Just kidding. A beautiful BMW. So what is a convertible note? Convertible debt is capital that you're bringing in that begins as debt and converts. Again, I love to turn the word. It's debt that converts. Converts into what? It converts into equity. It's capital that begins in debt as debt and converts into equity upon the next financing round, whichever is less, and we'll talk about that with a discount rate. So some terms that I want you to know, we're going to spend a minute or two on in convertible notes. And I want to make sure, even outside of this, just make sure you understand this, right? So if you're raising a convertible note, if you're doing an early seed round and you're doing it as a convertible note, you're raising $750,000. Again, a number of you are way beyond that. Everybody's at a different point in their business. Make sure you understand what the discount rate, what that means, and a valuation cap. And let me give you an example. I was with a couple of Dreamit companies a year or two ago, I think it was 2 years ago, and I was in an event with them. And I went up to them afterwards and said, oh, how did the event go? And they said it went pretty well, but we're really this was towards the end of the program. And I said, they said it went pretty well, but we have a concern. So what's that? So we had a couple of investors come over and say they were interested in investing. And we said, cool, we're going to raise a convertible note. And they said, great, what's the discount rate? And what's the discount and what's the cap rate? And they said, we told the investor, well, we're not exactly sure just yet. Can we get back to you? And I said, what did the investor say? And they said, absolutely, get back to us. And I said to them, I said, oh, okay, cool. I said, so what's the problem? They said, well, the reason we want to get back to the investors, we don't understand what the hell they're talking about. What's a discount rate and what's a cap? We don't even know what the terms mean. I was like, okay, well, that's a bigger issue. So these are important things to realize. So let's spend a couple minutes on them. So the discount rate just means when you're issuing a convertible note, so let's say you're raising $500,000 as a convertible note, it means the convertible investor is offered a lower price than other investors when that note converts at the next round. So they get a discount for the next round because they're taking a risk by putting, let's say, $500,000 or $1 million into you total. They're going to get a discount rate, and it compensates them for that risk. Just so you know, today, this is almost June 2016, the typical discount rate that we'll see in a convertible note is around a 10 to 20% discount rate. So again, today, June 2016, typical number you'll see in an early stage seed round note is about a 10 to 20% discount rate. Then the other thing is the valuation cap. So valuation cap, it delays that valuation negotiation because it's not an equity round, but it gives protection to the investor and offers a cap rate. And the lower the cap, the better the deal the investor gets. And the whole point here is, let's say I'm doing a small convertible note for $500,000 and people are putting in $500,000 in, and then the round, that converts at a 15% discount. And then the company takes off wildly like crazy and is going to go do a Series A, let's say is the next round, and it's going to do a Series A and bring in $20 million at a $100 million pre-money valuation. And now their little $500,000 investment or whatever it was in the beginning is worth very, very little. So they'll put a cap on it and say, well, it's a not to exceed rate in the next round, so they can make sure they're actually buying a meaningful amount of the company. So that's called a valuation cap. So again, the point is, the lower the cap, the better the deal that the investor gets. So a lot of times an aggressive entrepreneur, they'll say, what's the cap rate? Not the cap rate, excuse me, that's real estate. What's the valuation cap? They'll say, well, it's a $10 million valuation cap. Well, like, absolutely not. The VC or the angel investor, I'll do a $4 million cap or a $5 million cap, but I'm not doing a $10 million cap. They want it lower. Okay. So, and generally a lot of times we'll see a cap rate about $4 to $8 million is the typical cap rate that we'll see. So get a discount rate as of June 2016, because things fluctuate. Discount rate's about $10 to $20 million, a 10 to 20% cap rate of around $4 to $8 million is the cap rate. So this just gives an example of a discount rate. So $500,000 convertible note going in at a 20% discount rate. Then the next round, a price round, it's $1 a share, but they're buying it at a discount, 20% off, 80 cents per share is what they're buying it for. Same shares, every other investor is paying $1. These investors are paying 80 cents because that's their discount rate. So there's the conversion. The next example just shows what happens if a cap is in the way and you're exceeding the cap. So let's say somebody invested $500,000 in a convertible note with a $4 million cap. The next round is being raised at $1 per share, but it's a $16 million pre-money valuation. The company is quickly taking off. Now you're going to get a discount. They're actually going to buy it as though it got right to the cap but no further, and they're going to pay 25 cents a share. They're going to own about 12.5% of your company, because even though you went smashing through, they gave that money. They invested in you very early in the convertible note, and you hit the cap, and that's it. They're just going to invest at the cap. They're not investing at that very high valuation that you achieved, and it's protecting them. Okay. So convertible notes, other things. Again, I'm not going to go into excruciating detail. Just flip through this if you have questions. Ask, what's the amount of principal? What's the interest rate on the note? Typically it's 6 to 8%. What's the definition of a qualified financing, a QF, qualified financing event? And what's the maturity? Because a note can become due, right? There's that 18 months we said. Typically you're raising around 18 months. So a lot of times, 24 months later, if you're borrowing a $500,000, that $500,000 becomes due. So there's a maturity rate as well. Okay, and again, just flip through the slides, and if you have questions, ask us. There's a lot of times where you have conversion triggers. When does that convertible note, when does it convert? What are the conversion triggers? Usually around a qualified financing. It will convert at maturity if it hits the 18 to 24 months. There can be a voluntary conversion or a change of control. What if the company gets acquired before it even gets to the next round? It'll convert as a part of that acquisition process. Okay, more modern things you see in these rounds and seed rounds, you see things like safes, and you see things like kisses. Safe is a YC instrument, or YC came up with it, and it's really clever and smart. And KISS is the 500 startups kind of version of that. It's actually different, but they're very clean, lightweight documents. So safe, in exchange for money, an investor receives the right to purchase stock in a future equity round subject to certain parameters set in the safe. And let's talk about that. So SAFE, what it stands for literally, is a simplified agreement for future equity. These documents and structures, which are very smart and clever, and by the way, you see a lot on the West Coast of the US. Well, you don't see these used a lot on the East Coast. If you try to bring these to an East Coast investor, they'll be like, what's this? Well, it's a SAFE. Never seen one. It's a very West Coast financing structure, but it's clever because it's lightweight, it's fast, the docs are really simple, and it gets that deal done quickly. So typically it's about a 5-page document. It's a convertible security versus a debt instrument. It's a CS. It's not a full debt instrument, so there's no issue around insolvency where it matures. It's not a loan. It doesn't accrue interest, and there's no need to request maturity extensions. If you're bumping up that maturity in a convertible note, you don't need that, because it's actually a simple agreement for future equity. It's not a note. The key parameters you still need to negotiate: what's the valuation cap, what's the discount, and is there a most favored nation clause? Meaning, if you offer one safe to one investor and you're still doing your round and you offer different terms to different investors, sometimes the safe will say, well, if you give better terms to somebody else, I want the same terms. So terms, so those are the things in a safe. Okay, I want to back out completely and just talk about term sheets in general, and then get into the docs and see if we can get you wrapped up in the next 20 minutes, because I know I'm going through a lot of information really, really quickly, and again, trying to highlight where we see companies make the most mistakes. So there's a lot of terms when you're negotiating a term sheet and when you're doing long form docs, and there's things worth fighting for, and there's things that are just like a little bit more let it go. Right? Valuation is important. It's not the end all be all, but valuation is important because there's all kinds of other ways, other things that a VC can negotiate besides valuation. Liquidation preference is really important. So you'll see a company that says, I got a great deal, I got great valuation, but they wound up with a 3x liquidation preference for the VC. And you're like, yeah, not such a great deal. The structure of the board of directors, we talked about that. The protective provisions to make sure you understand what you're allowed to do with your company, even if you think you still have control. How your stock is going to invest, in how it's going to vest in your own company. The anti-dilution protections over time. And exclusivity of when you get a term sheet. What's the exclusivity? Who else can you talk to? Okay. So I want to talk a little bit more about managing the negotiations of the term sheet. So when you're getting a term sheet, if you're getting a draft of it, as you go back and forth, again, don't agree to anything before you have your attorney and advisors look at it. For those of you that have boards, having your board look at it. Make sure to give your lawyer advance notice, like, oh, by the way, Ira, I think I'm getting a term sheet in the next 3 or 4 days. And that's all, just as a heads up, so they're ready for it. And also make sure to provide a time frame for the response to investors when asking lawyers to review it. So if you send it to a lawyer, say, look, how long is it going to take to get through it? Because I want to set the expectation for the investor who's given us this draft term sheet before we sign it, just to keep the process moving along. Again, make sure that you own the process and that you're managing it and driving it professionally. Okay, so as you get issued a term sheet, you're going to go into the due diligence process. So I want to talk about that. I'm going to just stay on this slide for a minute. Again, a mistake I saw about a year ago with a Dreamit company that was a little worrisome. I was in a conversation and somebody said to me, well, so we're in due diligence. They said something along the lines of, we're in due diligence with 2 or 3 different firms. I said, great. I thought you're still waiting for a term sheet and a lead VC. Well, we are. We're still trying to secure our lead, but we're in due diligence. I said, wait, what? How are you in due diligence if you don't have a lead and you don't have a lead investor and you don't have a term sheet? And where they got confused was they had investors asking them for kind of deeper questions, deeper financial projections. And the entrepreneur started calling that due diligence. That's not due diligence. That's asking more detailed questions. And again, excuse me, I just want you to be careful about the lingo, words that you use. Due diligence means a lot and has a very specific definition of what due diligence is. So just want you to be careful about terms like lead investor due diligence. Because they were going out and talking to other investors and literally saying, look, we're in due diligence with a couple other investors, but we're still looking for a term sheet, and making themselves look not that educated about the process. And you just want to make sure you understand the terms. So sometimes there is a bit of quote unquote due diligence before due diligence. So some VCs are going to dig deeper, much deeper before issuing a term sheet. They want to do a light version of a deep dive. The amount of due diligence prior, and again, just investigating more deeply, prior to issuing a term sheet increases the probability it's going to happen. So if they start drilling down saying, look, before we issue a term sheet, can we get a deeper look at your financials? We want to take a deeper look at your pipeline. That's okay, and you could do that if you're feeling confident about it. Just be careful of the terminology you use, because what they're trying to avoid is last minute surprises. Nobody wants a last minute surprise after they've issued a term sheet. Okay, so let me give you some examples of when we've seen VC pull term sheets, and they do. We've seen deals fall apart. It's one of the reasons we put this seminar together. People would get a term sheet and they're like, yay, I'm done. Remember that that runner that falls short at the race. We don't want that happening. Why does it fall apart? Financial negotiations, you're asking for really non-standard terms. And you know, a great VC firm, a really, really great VC firm that's kind of honking and big and well-known and branded, you know, is going to see 2, 3, 4, 5,000 deals per year. Right? And they want to invest in something that really makes sense to them, kind of fits the mold of what they're looking for structuring. So if you're coming in with all kinds of aggressive non-standard terms, you might be able to get a deal done. But, you know, I met with a VC the other day. You know, they do 2 to 3 deals per year. They invest in 1% of what they see. And the more non-standard you are, the more outside the box. You know, they want you to think outside the box, but not about their deal terms. The more difficult you're going to create. If your stock option plan is less than 15% for your team at a seed round or going into a Series A, that's going to be a bit of a red flag because they want to make sure you're going to incentivize the rest of the team. Weird vesting schedules, high founder salaries. If you're sucking money out of it, you know, quickly, that's a lot of times where they'll be like, not interested. Repayment of founder debts. So just a quick thing, some of you may be not taking any salary. I've done this. They're deferring salary, taking partial salary. And for a year, you know, instead of taking $100,000 in salary, you've been taking $30,000 in annualized salary, and you've been deferring $70,000, right? So now it's a year later, you're closing your deal, and you say to the VC, by the way, I'm now going to get repaid the $70,000 that I kind of gave up for a year. It's a repayment of the founder debt from proceeds. They're going to be like, yeah, no, I don't want to do that. I'm not paying for your stuff going backwards. I'm paying for the future, not the past. And if you push that too hard, a lot of times the VC will be like, no, then we're changing the deal terms because I want to put my $1 million in going forward. I don't want to get sucked out in the past. Another quick note, by the way, almost every VC that you deal with that's a professional VC is also going to say no finders. They don't want 1% of your money going to a finder that help you secure financing. If they think there's an investor syndicate unlikely to invest in future rounds. Certain things in due diligence will knock you out. You're not hitting your plans. Customer issues. You say, here's 4 great customers, and they talk to them, and it turns out it's not true. Management issues, poor leadership, weird discrepancies in materials. Your story doesn't hold up. So we keep talking about with you all the time, and in the investor prep sessions coming up, what's your story? Is there a record scratch? How does it hold together? What's the evidence? Where is this all going? What's your big, hairy, audacious goal? That story has to hold up under scrutiny. So when we talk about have a story, it's not a fairy tale. Some of it is in a sense because you're projecting the future, but it's got to hold up and hold together. So one thing I want to tell you that's really, really important when you're telling your story is don't lie. Don't stretch it because you'll get caught. And I've seen people get caught, and it is devastating. So you want a story that holds together. You can't perfectly predict the future, but don't bullshit a bullshitter. It's really important. And let me give you an example of this. Several years ago, there was a company I knew of that was out there, and it was on something as subtle as talking about founder credentials. And they were getting issued a term sheet, and in the founder credentials, they talked about how one of the founders had their PhDs. And during the due diligence process, one of the venture investors actually started pulling college transcripts because that's their normal way they do it, and started pulling college transcripts. And it turned out that one of the entrepreneurs had dropped out of their PhD program and never finished it. They were ABD. They were all but dissertation, and actually some of their coursework was missing as well. And they were going around with their name, comma, PhD, and saying they had completed it. And they basically were lying. And the entire deal fell apart. That shattered the investor's confidence because if I was investing, think of it like this. If that man or woman is lying about their PhD, what else aren't they telling the truth about if they're not telling the truth about that? And it shatters confidence. And all you need is that one little poke, and the whole thing starts to fall apart. So please, tell a story, but don't lie. Just be really, really careful and tell the truth. And if you get asked questions you don't know, say I don't know and get back to people, but be really, really careful there. So as you go through, you've gotten the term sheet, people start to do due diligence. I want you to think about being prepared for due diligence. You can be ready for it. A lot of people seem like they're almost caught by surprise. So let me tell you about some great ways that you can be ready for it. First of all, establish what's called a data room, a virtual data room. Easy to do. You can do it in Google Drive. You can do it in Dropbox. You can do it in DocuSign. You can do it in Box. that all of the documents that you sign, so when you get your Dreamit investor agreements, your employment agreements, your lease, your whatever the documents are, your customer agreements, your pilot agreements, all of those, as soon as they're signed, scan them to PDF and drop them into Dropbox or drop them into Google Drive. Don't leave them as paper. And hopefully you're using things like DocuSign from the beginning. I mean, we do that a lot at Dreamit. Everything's electronic now, so drop it in there. So all of those critical documents should be dropped into Google Drive, Dropbox, whatever you're using. Save it with a long descriptive file name. Don't use cryptic like customer agreement or customer agreement 1, right? So if I was doing something with Penn Medicine, it would be Penn Medicine finalized trial agreement fully executed May 2016. So it's easy for me to search. It's very descriptive. It's very long. Develop a secure, organized way for filing those away. And as a matter of fact, I will actually file and then shred. I will, if it's on paper, I will scan it to PDF. And I'm kind of brave. I will then drop it in a shredder because I've got it electronically. So it's great. So I've been in situations where people are like, we need to do due diligence. And like 3 days later I'm ready. Because kind of everything, when an employee signs on, I've got a new employee or a new contractor, or if there's a separation agreement, unfortunately, if somebody is separating from the company and they have to sign a separation agreement, as soon as that's signed, I scan it, drop it into, in my case, I use Google Drive, drop it into Google Drive, or I use Box. I'm going to drop it into Box where it needs to go, and it's ready, and I'm kind of always ready for due diligence. You can ask investors for their standard due diligence checklists. Usually they're pretty standard, those checklists. So just think about it. You can always be ready for due diligence. And I find people, it's like, oh my God, this is going to take me weeks. It should be pretty simple and straightforward if you stay organized. The other thing on due diligence is, remember, diligence your investors. A lot of people say this is like getting married, and you want to understand, is this person a jerk? What's going to happen if, also when you do diligence on an investor, if you ask that investor to give you a couple of references or find them on your own, it's pretty easy to do. Make sure to talk to entrepreneurs that have had a failure with that investor, because you learn what people are like when the shits hit the fan, right? When the chips are down, that's what how you learn an investor really behaves, right? So do your diligence on investor by reference checking with companies that have been both successful and failed. And everybody likes to give you your successes. It's great to have a failure or two to see how they've behaved in those situations, because that's what you're going to learn when they're made of. Okay, this is a typical due diligence checklist. I'm not draining through the whole thing here. Just, like one of the big things though is attrition. If people have left your team, why did they leave their team? Leave your team. So they're going to look at things like that. But this is a typical, and usually it'll be a page or two of questions. Again, it's pretty straightforward. There's, by the way, bottom left, stock option plan. So if you have a stock option plan, that's in your data room or your due diligence room. If the employee has signed their stock option plan, as soon as it's signed, if you've used something like DocuSign, take the signed PDF, throw it in the data room. Just keep organized. It just makes life easier. And really descriptive file names, really important, like we talked about. So some due diligence best practices. If you're now going through almost like the hand-to-hand due diligence, ensure your team knows the vision presented in your investor pitch and roles in achieving. So if an investor says, look, I want to talk to your chief marketing officer, I want to talk to your chief technology officer, you're the CEO, and I want to talk to the person in charge of customer service, make sure you've taken them through your pitch deck, meaning your internal team, and that everybody's on the same page. Make sure your team accurately reflects their roles on LinkedIn, their resumes, social media. If you call them their chief product officer, but on their LinkedIn profile it says something completely different, just make sure everything's aligned so you don't give anybody pause. There's one person who's on point for communications. A lot of time it's going to be you, the CEO and co-founder. Answer investor questions thoroughly as you go through the process. And I'm just realizing I haven't looked at all to see if there's any questions coming in here. Nope, there haven't been that I see. And prepare your lawyer to answer questions from investors and their lawyers. You can certainly do that lawyer to lawyer. They can answer questions. And validate the satisfaction of reference customers in advance. So if you're going to give 3 or 4 customers as reference customers, make sure to talk to those reference customers in advance and say, is it okay to use a reference customer? And make sure they're sure about that, because you don't want to give 4 customers and one of them's like kind of squishy on you. That's not going to help you when doing due diligence. Okay, let's go to the end of it here and hopefully get wrapped up in the next 5 or 10 minutes in raising around. So now let's talk about closing and receiving the wired funds. And that's a good thing. So as you get through due diligence and as you get into the term sheet sign, now you're going to get long form documents. And I saw one thing just flash up on my screen. I'll come right back to it in a minute. Let me just kind of get through this page and I'll come back if there's a question. So long form documents. So you get your term sheet, right? And then you're going to get long form documents. You're not done at the term sheet phase. You have due diligence and long form. So after the term sheet is signed, typically investor will supply you with long form documents. They're going to send you, typically if you're doing like a Series A preferred, they're going to send you, for instance, an SPA, a share purchase agreement, and more. If it's an equity round, you're going to get a lot more. If you're doing a convertible note, you're going to get things like a promissory note and more, and investor rights agreements. All of these are going to have reps and warranties, or representations and warranties. So reps and warranties that you haven't committed fraud, that you own all the software, that you're not infringing openly on anyone else's IP. So they're going to ask you to rep all of these things. They're going to ask you to rep that everything that you've told them is true. They're going to ask you to represent and put a rep and warranty that there is no ongoing or pending litigation. There's no litigation that you're expecting. So they're going to ask you to sign a series of reps and warranties that you're going to want your attorney to review in advance, and a whole lot more. Your attorney is on point for reviewing all of these long form documents, but again, you want to make sure that you're sitting over them, driving this process to close and understanding the timeline. Just please note that it is typical, just so you're not caught by surprise, that if you're negotiating a deal with a VC, you're typically going to pay both law firms legal fees, which is a delightful thing. So typically you pay for both parties' legal work. It's just that's what's normal. I don't know if it's fair, but that's what's normal. Let me just see if there's one question I saw pop up before. Just give me a moment. There was a chat thing. So Balaji asked, is the due diligence process order of operations different between VCs and angels? So again, the question was, is the due diligence process or the order of operations different between VCs and angels? I'd say no. I typically find it's the same. Again, angels are a little bit more relaxed in the way they do things. VCs are a little bit more buttoned up. So angels might do a little bit more, I'd like to talk to a customer or two before I even send you a term sheet. They may ask that. I find they're kind of equal, but I can tell you this, VCs on the due diligence process, because they're investing other people's money on that due diligence, they're going to go into a lot more detail. An angel will be a lot like, okay, I trust you, I'm writing a $10,000 check. It's good enough for me if you've got 10 other people around the table. VC is going to do a lot more due diligence. That's what I would say is the big difference between the two. Thank you for your question. Can we close that window? And let me go back. So those are your long-form documents. Last couple of things to keep in mind here. Your deal is done when the money is, I used to say the deal is done when the check clears the bank. I will just say the deal is done when the wire transfer these days hits the bank account. There was a deal I heard about a couple of years ago where the wire transfer went to the wrong bank account and it took 3 days to correct it. Heard all kinds of weird things. But you, when you're driving and owning the process, again, I've heard Dreamit companies, the deal fell apart. Why? Well, something went wrong between the attorneys. Well, how on top of the process were you? Well, not really. The attorneys owned and drove the process. No. Not a good thing. Not a good thing. So you're done when the money is in the bank. That's when you can celebrate, okay? One other thing I wanted to bring up about you're done when the money hits the bank is if you have a tranched investment. Now, I was actually watching Silicon Valley the other day on HBO, and I don't know how many of you watched that. I think I was 2 episodes behind, and the finance guy was talking about, well, if they tranche the investment. So tranche, I actually looked up a couple of years ago, is a French word. Literally, it's like trench. It's from the French word trench, where you have a stopping point. So realize sometimes an investor will say, well, I'm going to tranche the investment. And I had a company that I was talking to, a Dreamit company, a couple of weeks ago, say, well, we're raising, $3 million, but we really need $250,000 to really figure out this big next thing. Then we're going to know everything. I was like, if you say things like that when you're raising money, they're absolutely either going to say, you know what, I'm going to do a convertible note, or I'm going to do something for $250,000, or they're going to tranche the round. Meaning they're going to say, fine, we'll do a $3 million round, but I'm going to give you the first $250,000 up front, and then we're going to see what happens. But I'm not giving them the rest of that money until you hit that significant milestone. You'll see this in life sciences companies where they have to get through certain types of trials, and they'll literally tranche the round. So if you hear that term, don't be afraid of it, but be careful what you say, because you might bring it onto yourself where they're not going to give you, I'm raising a $3 million round. They're not going to give you the whole $3 million up front. They're going to put certain milestones you must hit by a certain time frame. Otherwise, you're not going to get the rest of the cash. So you want to be very careful if you're negotiating deals like that. So tranched investments tie funding to milestones. I just want you to be familiar with that term. It comes from the French. Okay, if as you go through this process, If you have questions, I've gone through a lot of terms today. A lot of them I went through lightly because you have the deck in front of you and they're pretty straightforward. If you have questions, ask me your managing directors meeting. Hit me on, if you want, hit me on LinkedIn or over email. I'm happy to answer. Managing directors can all answer these questions. As you're going through and you're meeting with investors, if you have things come up and you want our opinion, feel free to ask. We're always happy to give an opinion. Help is always just a phone call away. And that's true, by the way, once your acceleration phase of 4 months finishes with Dreamit, you can always call us. We're always there for you. We're always happy to answer questions. I worked on a company, SeatGeek, in 2009. They haven't called me in the last year or two. But I would take questions from those guys. I'd take questions from other people. We're always happy to help. Phone call. It's just a phone call away. Okay. The key takeaways. Remember, we had a previous deck to this that talked about how to write a great pitch deck. This was more on the fundraising process and closing around. You have the great story. Now you're going to drive it to close. Key takeaways that I wanted you to make sure that you got out of this deck. You need to own and drive the process all the way to when the funds clear the bank account. Next thing is make sure that you understand the vocabulary and use it correctly. You don't have to understand every single word, but some of those key terms, pre-money valuation, post-money valuation, option pool, tranching arounds is definitely a key term that probably won't come up for most of you. Convertible note, price round, discount rate, cap rate, some of those you really want to make sure you have a good feel for what they mean. Okay? Make sure that when you're pitching, and I saw one question just popped up, I'll come to it in a minute. Make sure that you ask for the business, right? Think about raising money just like selling, right? It's just like sales. It's like selling your product. You're not selling your product, you're selling your equity if you're doing a price round. And you can ask for the business and get agreement and say, look, what are the things that would tip you towards making an investment in a company like this? Are you ready? Would you make an investment? Well, I have a couple of concerns. Great. What are those concerns? Well, they're 1, 2, and 3. Cool, so if I come back to you in the next 3 or 4 months and I have those 1, 2, 3 concerns knocked out, are you gonna write a check? I mean, would you make it? You could be a little softer than that. Are you gonna make an investment in a company like us? Sure, great. Okay, and understand what they are, and that's okay, you can do that. If you need help, ask your attorney, ask your advisor, ask Dream, but we're happy to help. So let me take a look. There was one other question that just popped up. Doug asked, will we be doing practice due diligence, aka finding the things that can hold up a deal before they actually hold up? We don't do practice due diligence. I think we're going to pound away when you do investor meetings and practicing your pitch. We're going to pound away on things. If you go through that checklist, you just want to make sure that things are buttoned up, right? If you have employees or contractors on board, you want to make sure you have those agreements written. Sometimes, by the way, you have early stage companies like, oh crap, we've got 3 outside contractors kind of working with us and we never got them to actually sign a formal agreement. Sometimes you have to go back and actually do some papering of things that are already in place. But we're not going to spend time actually practicing due diligence. But if you just look at what those checklists are, they're pretty straightforward of what you need to have in place. But we will go pounding through your models and challenging when you take your pitch deck and when you're pitching us, we will very openly challenge. So we answered that live. Okay, so thank you for your question. Let me see what else is in this deck and if there's any other questions. So here's some links for more information just about term sheets, term sheet calculator, convertible debt, safes, lots of good information, VC versus angel money. There's lots of good reading online and resources of more information that you can get. Okay, and a whole second, there's more. There you go for Doug, for due diligence process and what a typical checklist looks like. So if you have, Charles had circulated this deck in PDF earlier, so all of those should be clickable in the deck. And if you don't have it, if you just look online in Slack, you'll see where he circulated that. Okay, so this was all about crossing the finish line, how to close around. I just want to go back a couple slides. Trust me, I'm not going to drain you all through back this. I just want to show you something real quick and just kind of recap where we were here. Okay, so this was all, and I'm going to, looks like there's, okay, thanks Doug for your smiley face. Okay, so in raising around, here's what we went over today and wanted to make sure you understood. You start by initiating those investor relationships. For those of you going that are watching live, that are going on the Investor Roadshow, we're going to help you. And a lot of you have already initiated relationships. We just try to help you go faster to more and get a lot of momentum around your fundraising. You're going to be pitching investors with a great story that's believable with evidence. We're going to help tear that apart and make sure it's sound and with a good, hopefully big, hairy, audacious goal, a great vision. Hopefully you get past that first meeting and they say, come back. Remember the goal of your first pitch meeting when you're pitching an investor for the first 20, 30 minutes, it's one simple goal. get asked back for a second meeting. That's the goal. And eventually try to get to that partner meeting. From there, you're looking to get a term sheet and drive it to a term sheet from your lead investor. Then you'll have follow-on investors to help fill out a round. Usually they're called party rounds. Usually you don't have just one investor. You're going to manage that due diligence process. You're going to own it. It's going to be online. Hopefully you're scanning all of your documents with great file names and you're ready for due diligence. You then go through closing docs and you receive the wired funds at a high level. We had a Dreamit company in the last cycle. It was so hilarious. He reached out to me on Slack, and it was about a month after the investor roadshow. He had gotten a term sheet. And it was so funny, as things would go along, you go, Steve, it's great, because we're going through and we're like closing the round, and it's like just flipping through your deck, what's coming next? And it's great. It's like the deck actually gave me a preview of what the process looks like. Again, a number of you are raising your Series A. You're familiar with this process. Some of you haven't, so we just wanted to level the playing field and give you a high-level overview of what we see. So that's the deck for today that we wanted to take you through. Let me just bring it up here. If you have questions, let us know. We want to help you cross that finish line successfully. We want to help you de-risk your business, de-risk the fundraising process, and show you a little bit more on how to close around. Are there any other questions? We just had a couple of questions that came up. Any other questions from the people that are on live right now? Because otherwise I'll wrap up and we can answer questions in managing director sessions. We can answer them. Just again, hit me on Slack, whatever you need. We'll just give it a minute more. Okay, so thank you for tuning in today and listening in. Really appreciate your time. And we put this information together because we've seen a lot of people over the years have trouble. They'll get a term sheet in and then kind of drop the ball. We want to make sure you have a high-level view, a great deck, and a high-level view for how to get from meeting investors all the way through money in the bank. Looks like one more question just came in. Doug asked, should we set a time that we say we're returning to X city? I'd love to meet again, as we'll be back in X months. You know, I'm a big fan of what I phrase that as a geographic forcing function. You certainly can do that. You know, if you're in San Francisco, I don't know, you know, for instance, if you're out in San Francisco and you're an East Coast company or from outside the United States, you could do that. I don't know. You could just talk about what your timeline for fundraising is. I don't know if in the first meeting you'd want to set that up. You just want to ping them or understand in that first meeting, is this the type of thing that you think you or other investors would be interested in? You know, what are your, you know, do you have any concerns, or what would you like to take as next steps? And if they have concerns, understand what they are. You don't have to necessarily set a specific time of when you're going to be back in a city. I'd see where they are and feel them out on what they think of your company. And then later, what I like to do is, if I'm going back on a meeting with the VCs, you could certainly go back to those VCs you met with previously. Let's say, for instance, let's just do, again, you're an East Coast company, you're going back out to San Francisco and Silicon Valley. You're going to go meet with one VC. You certainly want to open it up. So you can go back, if there were two or three other VCs that kind of found what you're doing interesting, you could ping them and say, look, I'm beginning to be back out in 2 weeks. Love to know, could I get back out in front of you and give you an update if they seemed interested? And you could even try to get more investors while you're out there saying, look, I'm going to be out in 2 or 3 weeks. I'd love to know, we're meeting with some investors. Love to know if we could stop by for 10 or 15 minutes and tell you more about what we're doing and see if you find it of interest. A lot of that, by the way, remember on your initial outreach, your one-pager is going to be really important so that you can get that quick snapshot. Okay, looks like that's all the questions we had. We fit it in. I wanted to fit this in for an hour and a half for you. I'm sorry for going for so long. We wanted to cover a lot of information. Please flip through and read through the deck. If you have questions, let us know what they are, and we're happy to answer your questions, and we're happy to help. Thanks for tuning in today. Take care.